Okay. So financial statement analysis. That's where we are today. Financial statement analysis. Why do we need those financial statement analysis? Obviously, to assess the performance of the company. Which is the statement that we're gonna look at? That will be statement financial position, statement of income, statement of cash flows, statement of changes in equity, notes to financial statements. Which one is the most important one? We're gonna go one after another. We're just gonna see. The one thing that I told you in class is I'm going to show you this Cedar thing. Just a second, let me open one browser and I'm going to share my screen. So if you go to browser and you paste that Cedar, it's going to go Cedar Plus. Most likely it's a Cedar Plus, but let's stay with the Cedar. And Cedar Plus, yes. Once you click on the Cedar Plus, now the internet is slow because of the snow, of course. We're going to blame now on the snow everything. Okay, that's what it comes when it comes to Cedar. Here is where all the public companies are required to file their financial reports. And you can see a lot of things that you can do here. British Columbia Security Commission, so copyrights British Alberta Security Commission, Ontario Security Commission, and all the authorities which are related or applicable to the Cedar. Let's see what's about Cedar. What is Cedar about? So Canadian security regulations is the one. Ontario Security Commission. Cedar is consolidated. It replaces Cedar Plus on July 2. That's what's happened. And used to be called just Cedar. Now it's Cedar Plus website. That was Canadian longest running and most well known filing and disclosure natural system for market participants. This is for the market participants, the one who are trading their stocks on the stock exchange. So let's go with search with Cedar. In Cedar Plus, what you can search is links to information how to search on the Cedar. When you have videos, you have profiles, you have filings, you have filing for outstanding fees, filing for the profile, for search documents, search users. You can have a lot of options here to search, how to search for the company that you want to find out something. Now let's go and try to search and let's see what we're going to get here. I want to get out of this help center. Let's go back to the front page and let's go search Cedar. And you can find all the public disclosure documents. So once you clear, you're going to see this thing. Filing number, filing type, search profile, name, contain, search operator. Let me see how exactly was this. Let's go with Rogers. Filing number, document type. We can go with the annual reports, annual financial statements. Let's go with the annual financial statements. And let's see what we're going to get here. This profile delete search. So this profile is not, let's go. Start with or contains. Let's see if this one's gonna give us something. I don't think it gives us anything. There we go. Now we're getting something. Sometimes searching, sometimes it doesn't. I don't know what's the whole point, but the point is here to find the documents of every company that you're looking for. Okay, Mackenzie Corporation, Mackenzie. No, apparently that's not the one that we're looking for. Let's try to here. Finding category, finding type, document type, correct, start with. Let's see if this is gonna help us. Rogers communication. Now we have something here. Rogers communication, Rogers communication. Let's deal with this Rogers communication and let's see what we can find here. So Rogers communication, file it again, general. Let's see if we click on this one, what's gonna happen. That's not the one that we're looking for. I'm looking for the provider that you're using for your, let's try this again. No, let's move away because used to be very easy to search. They give you with the alphabetical number, um, documents, trader profiles. Let's see on the profiles if we click here, contains, starts with the Rogers. I guess I'm spending too much time company, and that will be Rogers. See if this is gonna give us something. Associated Rogers Communication Operation Rogers Communication Ontario. Maybe that's the one that we're looking for. Let's see if that's the one. I want you to see that financial reports. That's the whole point, and then we can see wireless communication, Rogers Wireless. That should do it, but why is the website is so super slow? I guess. And from here, search and download documents for this profile. You can see where the company is registered, reporting, uh, issuer, yes, everything is it corporation, where is the registered, everything, size of the issuer, assets, how much assets the company has, where on which stock exchange they're listed, then on Toronto Stock Exchange and New York Stock Exchange. Um, everything. Who is the auditor of the company? Where is the auditor address? Which are the previous issuers under this Rogers Cable, Rogers Wireless communication? From here, you can see certain documents for this profile. You can click here. Let's see what kind of documents going to give us. Now you can see the communication, new release, code of conduct, new release, certification, internal filing, management discussion and analysis. If you remember, let me show you something from the slides. If you're wondering what's that, as if you remember, on one point, we're talking that most of the company now presenting this management, here you go, filing relevant information. Which one the information will be relevant is to read the description of the business in the annual report of management discussion and analysis. So if you're wondering where that annual report of management discussion and analysis is, that's where it is. Once you see interim management discussion and analysis report for the Rogers communication, if you click on this file, it's going to come that interim. Let's see what's going to happen. Let's open it on the new. And can you guys see my screen?
Yes,
not, but you don't see what I'm seeing. Let me share another one with you. Let's make a one new sharing. So you can see actual the report. Here it is. This is what I downloaded right now from management discussion and analysis. Management discussion contains important information about our business performance for third quarter 2024 interim condensed financial statements. And here you can see what's the segment of principal activities. And this is where to find strategic highlights, quarterly financial highlights, summary for consolidated financial results of the reportable segments, review consolidated performance, and all these different elements, key performance indicators, material accounting policy estimates, and they start discussing. If you're interested in more about the financial statements of the company, that's another source for you to look at. Again, understand this is extra work for you, only for the people who actually are interested in investment, interested in to understand more about the Canadian business and the company that you most likely some of you paying Rogers, at least know to whom you're paying. The other thing that you can see here is the different releases. You can see here another interim management discussion analysis that's released on July. And let's see, next one. I'm looking for financial reports. Reports for voting results, certification, filing, interfiling, that's on April. And here's some more financial perspective, auditor consent letter, short perspective, primary management circular, notice of meeting, notice annual reports, French annual reports, French annual management discussion analysis. Well, let's see where is the English version, since I cannot read French. I mean, I can read French, but doesn't mean anything to me. Let's see where the English are. And we can just see for a second how the reports of the company, which is publicly traded, to look like. We have to wait now. The website to respond. Here we go. What we're looking, annual report, English. And you have annual management discussion analysis if you want to take a look later. For yourself, I'm gonna share you the annual reports. And I'm gonna stop here with this exercise. So here, what you can see is the record-breaking year on the annual reports. And people who smiling, people smiling, people smiling. Everybody wants to see people smiling. Why? Because they want your money. The guy smiling, he wants your money. That's their shareholders, their customers. We're focused on the customers. And keep going, keep going, keep going. We're a proud Canadian company. We are committed to investing in Canada. A record-breaking year, now record-breaking performance. What's happening? Record-breaking merger with the Shah. They last year they merged with Shah. Record-breaking innovation. Everything is breaking, record-breaking. They break all the records. Now the question is what they're going. If last year they break all the records, what they're gonna do this year? That's another thing for you to think. And if we scroll down, scroll down, scroll down, and here you can see the key financial information. Now, are we going to have enough financial information to assess the trend in the and performance of the company? Not from here, but if we download now reports from 21 to 20, we're going to have the revenues. Then we can compare the revenues. Then we compare the total service revenue. Can you guys see this information? You can see the where the net income is, which in this case doesn't make much sense. If the revenue goes with what is that in $1 million with $4 billion, why those $4 billion doesn't transfer to the income? That's something that probably you should look at. And why the earnings per share, when you have a record-breaking year, instead of going up, going down? That's another thing that you should look at. Now, what's going on here with this company? Even though they decrease the capital expenditure with that would be $800 million. Why the $4 billion increase in revenue haven't transferred into the net income? That's a big question. Something going on in this company. You can easily see this. That's on the consolidated side, and you can see from where the consolidated come from. Consolidated come from the wireless, from the cable, and from the media. So those 2 billion here plus 7 billion here plus 7 billion here gonna give you the, not gonna give you, that's 14, 15, 16, 17. Now we're missing something on the consolidated. There should be something else. And then we can keep going, keep going, keep going. They give you the ratios. Capital investing, dividend payout ratio, dividend payout ratio on the free cash flow, return on assets. They even give you the return on assets. The return on assets is 1.2%, which is enormously low. Debt leverage ratio is 5. And pro forma debt leverage ratio 4.7. Then give you the total active employee, which is in the company. And then you can keep going, keep going, keep going, keep going with the sources of which are the businesses, wireless, cable, and media. And at some point, you're going to start see the balance sheets, you're going to start see the income statement, and all the information that you need to know to do your financial summary of consolidated results. So now you can see the revenue. From where the revenue comes from, the wireless comes 10 million, 10 billion, 7 from the billion from cable, 2 billion from the media, corporate items in intercompany elimination, changing this. Now you need to understand what the consolidation means in order to understand those numbers. And you can keep going and read all the information about this particular company. So if you want to know more about the company itself before consolidation, what you can do is you can search for Rogers Wireless and then chase what's happening with those $10 billion. Why the $10 billion cannot convert into the income? How come from $19 billion you generating only 849 million, 849 million income? Why is that low? The previous year, from 9 billion, you're generating almost 2 billion. Now this year you're down. What's happening? Something happened in this company when they showing me that they have a record breaking year. In the record breaking year, their income plugging down. Something happened here. Obviously, they make some adjustments. As you can see, the adjusted income now make more sense. But even though, again, if you're showing me 4 billion increase in your revenue and you're showing me only 500 million increase in your adjusted income, you're not increasing the flow of the company. I mean, like a company, yes, reporting more revenue, but that revenue doesn't turn into income. So you have to dig deeper to find out what's happening with this company. There's something wrong with this company. They should perform way better than what they're showing here on the financial reports. So that's definitely a red flag. So let's stop with this and let's go to our slides. Now you can see from where the information come from. Which information? The information that we need to do the financial analysis. Now you can see where the Cedar is. Let's change this to Cedar Plus. Now, Cedar Plus is the website. And from here, we determine the purpose of obviously, we have to know why we need this analysis for. If you're just making analysis with no reason, there's no use for the analysis. You have to find a reason. Is it because I want to invest? Is it because I want to advise people to invest? Or is it because I want to advise the people not to invest? Then collect the information, prepare the common size analysis, which common size you already see that will be based on the percentage. And we have to analyze and interpret those metrics and develop conclusion or recommendation. We can use it so many type of analysis: investment, commercial lenders, credit department, pension funds. Definitely are interested in the company that produce steady, regular income year over year over year. Obviously, you have to understand the business by which are the operating activities in the business. As we see in the Rogers, they have media, they have wireless, and they have cable system. Those are the three main activities that are generating revenue for this company. We have to understand the underlying economic and risks in that particular industry. And we have to understand the overall strategy of the company. Key successful factors, as you see, those are listed on the management discussion and analysis report. That's the other report that you should look besides the annual financial reports. Then we have to review the additional information about the company and the industry, financial statements, obviously, including the auditor reports. As you saw on the information in CEDAR, we have those reports, auditors' reports, available as well. And the last thing that you have to pay attention is notes to financial statements. We're going to do two types of analysis. We can do prospective analysis, going forward, try to predict the future. Retrospective analysis, again, understand what's happened in the past. By understanding what's going to happen in the past, again, the objective is we to predict the future. That's why we're doing analysis, to go forward, not to go backwards. We're going to have a trend analysis versus sectional analysis. Trend analysis when we're comparing the information over 3 or more years, where the cross-sectional analysis is when we're comparing different companies in the same industry, or we're comparing the company with the industry itself. From where we're going to get the information about the industry? From Statistic Canada. If you chasing Canadian company, chase Statistic Canada. That's going to give you an idea what's happening and where you are. Make sense? Are you guys with me?
Yes, sir.
Yes, Thomas. Let me make you jealous. So, financial statements. Obviously, we're going to use to get this raw financial data, and those are going to appear directly on the financial statements. That's where we're going to get the information. And for the company that we start analyzing, we have those financial statements available, which we see that we looking at. We have 1, 2, 3, 4, 5 years in a row with the different information here. Again, we're starting with the revenue, and the bottom line is adjusted income before interest, taxes, depreciation, and amortization, and net earning as well. Ratio analysis is the powerful analysis. Why? Because we're looking in different categories: liquidity, activity, solvency, profitability, and equity analysis ratio. Liquidity analysis refer only and only to ability to the company to face the short-term obligation. In other words, what's the ratio between current assets and current liabilities? Current ratio is the current assets versus current liability, where the quick ratio is what's the most liquid assets which can be used to settle the current liabilities. For that reason, from the current assets on the above formula, we're gonna deduct the inventory and prepaid expenses. Why the inventory? Because the inventory is less liquid. From all the assets that we have, inventory is the less liquid assets. It takes 2 activities to convert inventory into cash. First, you have to sell the inventory. Second, you have to collect the cash from accounts receivables. Prepaid expenses. The prepaid expenses, the logic there is that whatever you've already prepaid, the chances that you're gonna cancel that prepayment are very slow or very slim, based on the fact that your company is gonna continue operations. You're not closing the business. So we saw this company, the current ratio, slowly improves in the right direction. What we're chasing here, what was the important thing? We to get the current ratio to be equal to 1 at least. What that means? That means that if the current ratio is equal to 1, that means only one thing for us. That means, let me see if I can click here and go inside. I cannot do anything. No, I don't want to pause this one. I'm trying to overwrite something and write something myself. So let's try here. What we're chasing here, we're chasing the current assets to be equal to the current liability. And only in that case, our current ratio is going to be equal to 1. Now the question is, do we want more than 1? More than 1, or you want it less than 1? Where we want to be. Obviously, if we are more than 1, that means the current assets is more than the current liability. And if the ratio is less than 1, that means the current assets are less than the current liability. In other words, in this case, you have more assets, where in this case, you're in trouble. You're literally in trouble here. Make sense? Company, obviously the current ratio improves in the right direction, increasing, going away from 1 in upper direction. Quick ratio stays below 1, which is okay in this case. Why? Because we excluding from the current assets inventory prepaid expenses. Even though it's below 1, it's on the right direction from 0.72, slightly drop down, and then climbing up. Activity ratio, the one that I want you to pay close attention. Those are the three ratios that I want you to know by mind. How to calculate them and how to interpret them, mostly how to interpret them. Now, the first one is the accounts receivables turnover, second one is the inventory turnover, and the last one is the accounts payable turnover. All the three ratio measures the same thing. First, they measure what's the turnover as a number, and then show you average either collection, either payable, either inventory days to sell your inventory. So first, accounts receivable turnover. How are we going to get it? First, you're chasing only and only sales on credit. If you collect it to your cash, there's no turnover there. You just get it. What you're chasing here? You're chasing the number to be as high as possible. Why high possible? Because after that, this number here, whatever you get as a number, that's going to go as a denominator, where in the denominator you have the number of the days per year. So if you have only a low number here, it takes you more day to collect your accounts receivables. If you have a high number here, it takes you less days to collect your accounts receivables. You always prefer here number to be higher. Obviously, if you have a sales on credit, that number here never going to be 365 or more than 365. Why? Because you have accounts receivable. That means you didn't collect your cash. Since you haven't collected your cash, at least the client, the fastest the client can pay you in the next day. Which means your denominator is going to be less than 365 days. Definitely. Now, how low can be, that's a different story. Can be 1. If the number here is 1, if you're getting credit sales minus the average divided by average account receivables, here you get number 1, and that number transfer here, that means it takes you 1 year to correct your accounts receivables. Obviously, you have to compare this number, whatever number you're getting here as an average collection period, you have to compare company credit terms. Because if the company tells you, my credit terms are 30 to 45 days, and they, on average, they're collecting, average collecting period is 60 days, that means they're not following the credit terms. The client don't follow the company credit terms. So, where we are here with this company, in our company, the number getting smaller. If the number getting smaller, that means the accounts receivables days in it's getting higher. That means it takes us more days to collect our cash. From 29 days, we went going up to 33 days. Again, why is that happening? Because as you can see here, we have numbers that getting slower. So every time when those numbers getting smaller, this number getting higher. And the opposite will be applicable. If those numbers getting higher, this number is gonna get smaller. Smaller number in accounts receivable collection period means you're collecting faster. Okay, next ratio, activity ratio, is inventory turnover. What's the inventory turnover in this case? Inventory turnover is how we're going to get it. You have to chase Cost of goods sold. Cost of goods sold. Once you find the cost of goods sold, then you're chasing the average inventory. How are you going to get the average inventory? Very simple. The average inventory, you're going to get it by getting beginning inventory plus the ending inventory divided by 2. Same thing, same idea is applicable if you have to calculate on the previous in accounts receivable turnover, you have to calculate the average accounts receivables. Now, from the data that you have available, if you have 2 years, you can only calculate those activity ratio for the second year. What that means is you're going to use the first year for your calculation. So you're going to get the first year ending balance in the first year will be beginning balance in the second year. Ending balance in the second year is the ending balance second year. So you're going to get beginning balance or ending balance in the first year plus the ending balance in the second year divided by 2. That's going to give you the average accounts receivables. Check the credit sales. Put this as a denominator. Calculate the number. Get that number. After that, move to the average collection period in number of days. Same thing you have to do with the inventory turnover. The only thing that you have to change is the numbers. First, you're getting the, that's accounts receivable. On the inventory, you're getting cost of goods sold as a denominator to get the inventory turnover and average inventory. Again, last year plus the current year divided by 2. Once you get that number, calculate the days to sell the inventory. How many days takes the company to sell its inventory? So 365 again will be your denominator. Inventory from the turnover from the previous calculation is the number that you're going to use as a denominator. Same idea here. Lower number, you're in trouble. Higher number, better. Can the number be more than 365? That's not going to happen. That means if I'm selling today, the client received the goods yesterday. Doesn't make sense, right? So it can be 364 days, can be 363 days, but it cannot be 365 days. That's pretty much impossible. Oh, 366 is absolutely impossible. So be careful with the numbers that you're getting here. It has to be actually, in this case, days to sell inventory can be 366 days. Yes, it can be 366 days. But can be 1 day? Yes, it can be one. Can be 0 day? No, it can't. The best you can get is 1 day. Also number here. So let's see how this company work here. The number for this company start going down. What that means? That means that they not selling the inventory. Or they're slowing on the sales of the inventory. Let's see the number, compare the number both charts here on one slide. So what we can see, once the inventory turnover start getting slower, the days to sell the inventory start getting higher. 7.3 transfer to 50 days. 50 days take you to sell your inventory. 6 transfer to 60 days to sell your inventory. 4.9 transfer to 74 days. Smaller the number here again goes, higher number of days you're going to get here. In order to reduce the number of days, this number has to go on the opposite direction. It has to start increasing. That's what you want as a manager. That's what you want if you are a flower business. So pay attention on the questions. Once you see the questions, pay attention on which business you are Is the number that you're getting makes sense for the business that you are in or the business that you're discussing? If you're in the bakery business and you're seeing the days of inventory is 50, 60 days, that doesn't make sense. You'll be way out of business before you see this number. If you're in business of the selling fresh flowers, again, those numbers don't make sense. Last ratio is activity, that's accounts payable turnover. Again, now we're chasing compared to the accounts receivables. In the accounts receivable, we're chasing the credit sales. Here we're chasing credit purchases. And again, denominator will be average accounts payable, which we're going to get accounts payable in the first year plus the accounts payable in the second year divided by 2. Once we get that number, we're going to see the accounts payable payment period or how many days take you to pay your vendors. Now, again, we're chasing the high number as possible because high number is going to give you lower day to pay accounts payable. Lower days you pay accounts payable, happy vendors. So what's happened with this company? The accounts payable turnover ratio is going down. And that directly transferred to more days in starts paying slower to our vendors. Let's see it from the same slide. So you can make a comparison and you can see the numbers. So again, when the number is 8.9, that means 41 days. Takes us 41 days to pay our accounts payables. When it starts going down to 7.4, that's transferred to 49 days. Once we move to 6.5, that means 56 days. So from 41, we're increasing to 56. How much is that? 56, that's 14 days. 14 days, that's 2 weeks. Always put the number, every time when you see the difference, put it in the numbers that you can be easily understand. Don't tell me 40 days or don't tell the users 14 days, tell them 2 weeks. 2 weeks is way more perceivable number than 14 days. Some people then they don't even know that 14 days means 1 week. 14 days means 2 weeks. Right? Put it in the perspective that the people can easily understand you when you're interpreting the ratios, of course. Solvency ratio analysis is going to show you what's the portion of the debt versus equity. And the next thing that we're chasing here is the interest coverage ratio. As we see in the classroom, net debt versus shareholders' equity is going to give you debt to equity ratio. Having in mind that those two are 100%, then the ratio is going to be in that range. So what means is that debt to equity here we got 0.59 in 2021 for this company. For 2029 we have 0.42 and slowly start increasing. What that means? Companies start taking more debt. That's all it means. Relatively to the equity portion. Is that good for the company? Well, net debt as a percentage of the total capitalization, which is the total shareholders equity plus the net debt. Now the total debt is 30 from 30% go to the 37%. Is this good for the company or bad for the company? It's too early to say. We have to check another ratio, which is the interest coverage ratio, which simply measures how many times the company can cover the interest expense from the earnings that the company generates. Higher number, better for the company. Means that company can pay more times the interest expense. Which are the interest expense? Interest expense is the expense that company pays, which are related to the net debt. If the company can pay the interest expense related to the net debt, that means the company borrowing for the company is cheaper. Let's see what's happened with this company. This company, that interest coverage ratio from 13.6, the first in the very beginning, they can pay the financial borrowing cost 13.6 times. Right now, they pay 15.7 times. So what that means to us means that the company don't have a problem to get more debt. So let's copy this one and see it on the same slide. Where are we at? Not this one. I want this one to stay, and I want to copy only this chart and flip it right here. Let's see if this is gonna work. Okay, yeah, this one works. So as you can see here, when the debt is 42%, we can cover, we earning, and with our earnings, we can cover our financial cost almost 14 times. Now the debt increasing with 17%, but our interest coverage also increasing by 2 times. So the earnings that we're generating are enough not only to keep the same, but even to increase the times that we can pay our financial costs. So the cost for the debt is small relatively to the income that we're generating. So in that case, even if you borrow a little bit more, it's okay for the company. Borrowing is not the problem for the company here. Why? Because obviously the company has ability to generate income, which is 16 times more than the financial cost. Okay, let's go with the profitability ratios. Those are the ratios that we didn't cover in class, so let's cover those one. We're going to chase the gross margin, profit margin, return on equity, and return on investments. So what's the gross margin? Gross margin simply shows you how much company generate, or for every dollar that the company gets as a revenue, how much is transferred to the gross margin, which is calculated only from the reducing the cost of goods sold. Profit margin measures the how much net income left in the company for every dollar of sales. Let's see this company. This company, for every dollar that they're selling, 20 cents transfer to the gross margin. Here, for every dollar that they're making, 22 cents, almost here 21, here's 22 cents, transfer into the gross margin. Now, let's see after the gross margin, what's happened with the net income. Let's compare those two so you can see it on the same screen and you understand the numbers. The whole point is you to understand the numbers. So, before the operating expenses and other expenses and income, we're getting 21 cents in 29. After the operating expenses and any other income, from every dollar of sales, we're getting only 5.6 cents. 5.6 cents we're getting for the every dollar of sales. Now, watch this. That's where our gross margin is 21 cents. After 21 cents in gross margin, then it's left for 5.6 cents. Now, the 2021, our gross margin increased to 22 cents for every dollar of sales. However, our profit margin decreasing to 4.4 cents. So that increase in 2 cents on the every dollar of sales, it didn't transfer to the to the profit margin. We should expect here our profit margin to be 6 or above. In fact, went down to 4.4. That's once what will be the 12 cents decrease? No, 1.2 cents decrease. Sorry.
Professor,
Yes.
can you give any example related to gross margin?
The gross margin. The gross margin example will be simply net income. Sorry, not net income here. Gross margin is the, let me see. Every time when you have, where can I write? Let me find somewhere to write here. Every time when you have revenue minus cost of goods sold, if you're a merchandising company, it's going to give you the gross margin. So this is the gross margin is related only and only to your main activity or main operations, which is to buy and sell a product. Make sense? After that, you have to deduct any operating expenses, which operating expenses are related to running the business itself. The cost of goods sold are related to the cost of the activity which generating revenue. And that's going to give you the gross margin. After that, you have to consider cost to running the business itself. So that will be administrative expenses, any electricity, any other expenses which are not directly related to your sales, but a part of the running the business. And after you deducting those operating expenses, you're going to get the net income. So basically, in that sense, the gross margin is the first check point. How much from the revenue after you pay the cost to generate that revenue stays with you. And the second number tells you from the number that you get from to run your to generate your revenue, how much cost you to run your business. And after you deduct cost of the business, how much left for you. That's how you should interpret those numbers. Make sense?
Yes, Professor.
So now we're going to the return on equity. Return on equity is simply for every dollar that I invest, how much I'm getting. So in that case, we need the net income on the top, which the net income is not, as you can see, this is the final income, not just the gross margin, the final income. And then we're going to see the average total shareholders equity. How are we going to get the average total shareholders equity? Similar to the previous activity ratio, beginning balance plus the ending balance divided by 2. And that's going to show you the how much return the every investors get. How much of the income is which should be distributed to the shareholders. Return on assets is going to give you from the assets that you have for the average total assets, which will be again beginning balance of the assets minus the ending balance of the assets divided by 2. How much of the income that you're generating is generated, how much is generated from those assets in terms of number. Now let's see how much is the percentage here for the return on equity. The return on equity means that for every dollar that you're generating, what's your return? And as you can see, the return from 14.8% goes down to 9.6%. Here, what we're going to see, not happy investors. How about return on assets? Before, we were using the assets better than now. Before, we can generate 8.4% return. Now, for the assets that we have, as you can see, the assets number going up. Average assets here are around 9 point something million, 9.5 or 9.4 million, where right now we're dealing with 13 million. On top of that, our net income going down. So that's transferred to the return on assets of 4.6%. That's the profitability analysis. The last analysis that we have to discuss is equity ratio analysis ratio. That will be earnings per share. For the earnings per share, there's a calculation here. First, we have to get the net income minus preferred dividend, any dividend which is owned to the preferred shares, if there are any. And then we have to get the weighted average number of shares outstanding. Weighted average number of shares proportional to the period where the shares were uh, issued. That's a complicated calculation. We're not going to spend time on this one. So that's why, for that reason, I'm not going to chase you on those one calculations. So what we can see here is we're going to see the basic earnings per share, 1.4. So how much of the income it belongs to every shares? The earnings per share here, $1.46, and increasing to $1.53. Here the shareholders will be okay. Where the diluted earnings per share, diluted earnings per share usually will be below the basic earnings per share, because in diluted earnings per share, we're increasing the denominator. We're playing with the denominator mostly. Then we're going to have a price earnings per share, which will be very subjective, but again, it's going to give you some idea where the company is. That will be the market price per shares divided by earnings per share. Here's the interesting ratio. That's the interesting ratio in terms of if you see here as an investor that the market price per share is below the earnings per share, that means the shares of the company are undervalued. That means you should buy those shares. Let's see what's the equity analysis here. The market price here is 37.79. Actually, you can see the market price slowly going down. Went down to 33, now it's 37. Again, you cannot predict the market. Market is very sensitive. Those people on the market are very sensitive. But the price earnings per share from 23 went going up to 24.7. Dividend paid out means how much dividend is per share versus the earnings per share. Is the ideal thing is earnings per share to be equal to the dividend that the investor is getting, but that's not the case. So in this company, the dividend was 66 cents, earnings per share is 1.94 the first year, or basically they're getting only 34%. And the last year, 70 cents dividend versus 1.53 earnings per share. So they give them 45% of the every dollar that the company earns. Dividend note, those are the note of the dividend and dividend reinvestment plan. So some companies keeping the dividend, they're not distributing it. Why? Because they want to have some cash for the future expansion. Usually, that's another thing that you should look at the company if you try to invest in the company to see is there any restrictions on the dividend policy. That's going to hit you directly, but that's going to hit you indirectly. Directly is going to hit you that you may not get a dividend for the shares that you own, but it can hit you indirectly by if the company keeping the earnings to expand in the technology or in the way that's going to increase the market share, then you can generate more profit by selling your shares for the share price to go up. Dividend yield is the dividend per share versus the price per share. That will be how much dividend I'm going to receive compared to the price that I have to pay for the share. It's all based on the estimations, the dividend yield. So for this company is now the only thing that is the thing which is past in the past periods, you can be rock solid. But if you have to predict that dividend yield for the next year, that will be something that will be very subjective. Here we already know that price per share from the stock market, and we know how much dividend we pay per share. So we can see what's the dividend yield here. Is that going to be the dividend yield next year? We don't know. Why? Because we cannot predict what will be the market price per share at the end of the year. That's the only problem. We can predict how much dividend I'm going to pay. The only question is I cannot predict the price per share. Net free cash flow. Net free cash flow will be how much cash free we're going to have if we, from operating activity, we deduct the net capital expenditure and dividend on the preferred shares. That's going to show you how much cash it's going to stay for the common shareholders. Which are the limitations of the every ratio has a limitation. All this analysis has a limitation. So all this analysis is subject to, how can I say, subject to uncertainties. Which are those uncertainties? Well, usually the investors, they don't understand much about accounting. So even though the accounting policies for different elements of the financial statements are discussed in the note of financial statements, users don't read those notes of financial statements first. Second, they don't understand accounting policies. Definitions of the ratios. Again, the users usually don't understand the definition of the ratios. Diversity of the operations. Company can have different sources of revenue, and you have to understand and you have to assess all of the sources of revenue. Is this business seasonal or not seasonal? That's another thing, because in the good season or during the season, the company is going to perform well. Off season, who knows? And there's always potential of manipulations. Why the potential of manipulation? Because the financial statements are prepared with intended um, objectives. One of the objectives that the people who presenting or people who wants to report the financial statements is simply to change the opinion of the users in the way that the owners of the company wants to be changed. Non-for-profit organization, if we have a non-for-profit organization, how we're going to deal with those non-for-profit organization? They also have the ratios if they're not-for-profit. Let's see which are the non-international financial reporting financial measures. All those ratios are required by international financial reporting standards. Is there anything that we can get but is not required by the international financial reporting standards? Free cash flow is not required. Earning before interest, taxes, depreciation, amortization. Net debt, debt to equity, interest coverage, net free cash flows. When you're interpreting the ratios, be very careful, especially when you're using those non-international financial reporting standards measures. There's no standard definitions. Sometimes whatever you measure, it might be not comparable. and information which is used to determine the measures, it might be not checked by anyone and obviously not audited. That creates a problem. So you have to be careful when you're reading the ratios, when you're interpreting the ratios, and when you're explaining the ratios. But don't worry, with more knowledge and more practice, you're going to get better. The question is, are you going to practice? Question here is, this is the financial information of this company. There are two companies for the current year. What they have? They have accounts receivable, beginning, ending. They have annual sales. So that information can be presented this way. The other thing that they can do, the other way the information can be presented is accounts receivable, and you can have here 2022 and 2021. For the company, which is called Ivanhoe Foods, that might be the information here. And so what will be accounts receivable is in 2021. Who's going to give me the accounts receivable in 2021?
$7,740.
Which year will be that? 2021 or 2022?
2021.
2021 will be the beginning.
Yeah.
So the 2021, at the end of the 2021, they're going to have 6720. And at the end of the 22, going to have 7740. Right? That's how the number should be. Make sense? Why? Because on January 1st, 2022, you have the ending balance on 2021. When on December 31st, on 2022, you have the ending balance. Make sense? Do you understand this logic?
No, Professor.
No, sir. Can you please repeat that again?
Yes,
Yeah,
I can repeat this one. So, if the information is like this, January 1st, December 31st. If this is year 2022, and this is 2022, what's the balance at the end of the 2022?
7740.
When if you have to prepare the financial statements at the end of the first year, my balance will be here 7740. Make sense? My accounts receivables at the end of the year are 7740. Correct?
Right.
Now, what is the accounts receivables in the beginning year of the year? Well, obviously, at the beginning of the year will be the same as the ending of the previous year, correct?
Yes.
Does that make sense? Today is February 2nd. Did you check your bank balance on January 31st? How many of you know your bank balance on January 31st? Did you check your bank balance on February 1st? Was there any difference?
no.
So if you say yes, that means, so no, watch this. You get interest, but usually at the end of the day. So watch this. If when is the January 31st ending? When the January 31st ending? at 11:59, correct? PM. Make sense?
Yes.
Where the February 1st starts?
At 12 a.m.
00:00 a.m. So if my balance at 11:59 is $1,000, how much will be my balance 1 second later?
Same.
Same. Can I get interest during that 1 second? That's the question.
Probably not.
Probably not. So for that reason, for simplicity, whatever. So now let's pretend this is not January 31st. Let's pretend this is the December 31st. And this is not February 1st. This is January 01st. And let's pretend this is the 2021 and this is 2022. So what that means is the ending balance for 2021, it's going to be equal to the beginning balance of 2022, correct?
Yes.
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 Sir.
So if I say, do I have to give you the beginning balance of 2022 then? Or the other way, instead of giving you the ending balance, the beginning balance of 2022, can I give you the ending balance of 2021?
Yes, it will be
Yes.
same.
Yes, sir.
And that automatically is going to become the beginning balance for 2022. Make sense?
Yes.
Yes,
Okay.
sir.
So now, let's keep going with this. That was a good exercise, right? So now let's see this. Your information is going to be given this way. So now the question is, can you calculate accounts receivable turnover for each company? So we have two companies. This is one company. Let's make this another one here, and let's get at the other company. The other company is this company. Let's change those covers to be more colorful, more interesting, and like this. So we have those two companies. Now, what will be the ending balance for this company now? Applying the same approach like before.
1,920.
920.
Okay, that will be 1,920. What will be the ending balance for 2021 then?
1,640.
Okay. So, at this point, can I calculate accounts receivable turnover? The question is, what do I need? For the accounts receivable turnover, I need my nominator to be, what will be my nominator here? Yep.
Beginning balance plus ending balance upon 2.
No, my nominator here. I'm chasing my nominator. What will be my nominator in the formula?
Is it credit sales?
Credit sales.
Yeah.
And what will be my denominator?
Average receivable.
The one that
Average.
you told me, right? That will be the average receivable. Now comes Candy, the one that you said. Accounts receivables. Accounts receivables turnover. Do I know my credit sales? Well, the question says that all my sales are on credit or on account. On an account means on credit. Okay. If all my sales are on credit, what that means? I can start using the formula, correct?
Yes, sir.
Yes.
What will be my nominator now?
60,000.
Okay, that will be my nominator. What will be my denominator?
Ending balance plus
Beginning balance.
Okay,
Right.
and beginning balance, which will be 6720 plus 7740 divided by
Right by 2.
2. All right. So if I get those, put this one here. If I get those two, what I'm gonna get? Let's keep working with this one. And we're gonna have as a nominator, so it's gonna be 6.8.0. That will be my number here. See, and then my denominator will be,
7,230.
let's put the formula now, 6720 plus 7740 bracket divided by 2. Is that what you're getting?
Yes, sir.
Yes.
So my accounts receivable turnover in this case will be
8.37.
7.
this one divided by that one. Is that what you're getting to?
Yes, sir.
Yes.
8.38. Now, if the question asks you what's the average days of accounts receivables, what you gonna say?
So 60 by
Yeah.
average.
So average
account
collection, that will be average collection period.
days.
Average collection period. How much my average collection period? That's too much stretch. Let's bring it back. Now I have to do new formula, correct?
Yes.
What will be my new formula? 365 is my nominator. Always, because 365 days is my nominator. And my denominator is accounts receivable turnover. The one that we just calculated, correct?
Yes.
So what we're gonna do now? 365 divided by
8.38.
8.38. Make sense?
Yes.
And where we are? What is our result?
43.5.
56.
5.6. What is that?
Days to collect.
Days.
Days.
Don't forget, this is not just 43.56. This is 43.56 days
Days.
to collect accounts receivables. Are you happy with this? Are you happy with your collections?
No.
No. Right? Let's see the other company, how the other company doing, right? What do we have to do for the other company? Let's copy this and let's move to the other company. What do we have on the other company? What's my nominator here on the other company? What do we have here? How much in my sales?
31,400.
31,000.
Okay, let's go with that. 31,470. 470 here. Where is my denominator? Well, I already have the numbers here, right? That will be 1640 plus 1920 divided by 2. Let's get the formulas here. That will be equal to this one. Let's move this one, and the next one will be equal to, let's put it this way, this one plus that one, and let's get rid of those. Now what's happened? If we're only chasing accounts receivable turnover, in which company the accounts receivable turnover is better?
The second,
The second one.
Why?
because it's higher.
Because the number is higher.
Yeah.
Right? What we said. Here we're chasing high number.
Mm.
Why high number? Because that high number is going to turn into the less days in
Less
collection.
days.
Is that happen? Is that
Yes.
what's happening? Yes.
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 Can you see it?
Yes.
Yes.
Yes. Which company if you have to invest, in which company you're going to invest?
The second one.
The
Second one.
second one. Make sense?
Yes, sir.
Okay. That's question one. Now let's do this. Let's see what's the next question in your assignment. So what's happening in this question? What do we know, what we don't know? First, we have the financial information, what they're giving us. We have information about cost of goods sold and inventory. If you have cost of goods sold and inventory, which ratio we can, activity ratio we can calculate?
Yes.
But which ratio we can calculate here? Inventory turnover, right?
Inventory. Yes.
So in order to get the inventory, what do I need? I need the inventory. What's my big ending balance of the inventory for Ivanhoe?
Ending will be 700.
6,90,000.
No.
So 2022.
Huh?
What's the ending balance on 2022?
6,90,000.
690,700. Okay. 2021. What's my ending balance in 2021? That will be beginning balance in 2022. Which beginning balance is January 1st, correct? Are you guys with me?
Yes.
Okay, so how much is this?
700.
748,900.
Okay. The other company, ending balance,
1,32,700.
700. Beginning balance,
4,680.
618,123. So what's happened with both company reducing their inventory? Can you see that?
Yes.
In the second company, that reduction is ginormous. Can you see that? Before we
Yes.
start any calculations, that's what we can see. Now the question is, how are we going to calculate this ratio? First, in order to get the inventory turnover, what do we need?
Cost of goods sold.
Exactly, cost of goods sold. Don't be afraid. Don't say it like a cost of goods. You have to be solid now. Yes, we need. Now I'm gonna go here with the inventory. I'm just gonna use the format from the previous question. And what we need is we need cost of goods sold. Yes, you're right. And average
Inventory.
Average inventory.
inventory. Do we have those numbers?
Yes.
Can we calculate it?
Yes.
Well, let's go for it. For the first company, how much my cost of goods sold?
9,069,480.
This number. Average inventory. Well, in average inventory, we're gonna have bracket of beginning balance is 748, 900 plus 690, 700 bracket divided by 2.
2.
Awesome. I'm going step by step so you can actually understand it, okay? That's still going to be my nominator. My denominator will be equal to bracket this one plus that one divided by 2. So where we are, what's our number here? 12.6, that's what you're getting?
Yes.
We get the inventory turnover. What's the next one?
Days to
Days of sale inventory.
Days to sell inventory. Days to sell inventory, right?
Yes.
All right. How are we going to get that one? What's our nominator here?
365 days.
365 days. Is that nominator going to change? What do you think? Is that nominator going to change from formal to formal?
No.
No. Why? Because it's 365. It's 1 year. 365. What we have on the bottom? We have the number inventory that we just
Turnover.
calculated, right?
Yeah.
Okay. Which are our numbers? Here we're going to have 365. And our bottom number will be equal to that number here. And then what we have to do, just to do the calculations when we are done. So how many days take us to sell our inventory?
29 days.
29 days. Are you happy with that?
No.
No.
You want it more, huh?
No, less.
So in order to get it more, what do we need?
Higher turnover.
Higher inventory turnover, right? This number has to be higher. Now let's do the calculation for the other company and let's see if the other company actually make it. So what's in there? And they have, that will be the cost of goods sold, right? For the other company. Why it doesn't show me this? That's my cost of goods sold. My denominator is, now we're changing the numbers, will be 4.618, 123. That's the first one. And the next one is 1.032, 700 divided by 2. We have our nominator. Let's get the denominator equal to this one plus that one divided by 2. Is it the number higher?
Yes.
What that's going to give us?
Lesser days to sell the
Less
inventory.
days inventory. Which one is better? First
The
one or the second one? Second one. Magically, they pull better days to sell inventory. Why? Because the inventory turnover is better. It's a higher number. Which industry those people are?
Food industry, supermarket.
Supermarket. On the fresh fruits, are you happy with 29 days selling your inventory?
No.
No. In the fresh fruit market. That means the oranges that you're selling them in 29 days. On the supermarket, 21 days. Are you happy?
Yes, better than the previous one.
Definitely better than the previous ones. But are you happy?
No.
What kind of food you have to sell in order to be happy in the supermarket?
Non-perishable goods.
And canned food,
Yeah.
right? Anything which is packed in the packages which doesn't require fridge and the fridge storage, I'm okay. Even if you require fridge, at least to be frozen, right?
Yes.
21 days, that will be okay. How can I speed up my sales? I want to improve that 21 days. 21 days is very slow. What can I do? Give me a day. How should I make those clients to buy more?
Maybe like discounts or something.
Why is so kind of uncertain and so kind of questionable? Of course, when you
And
see food on sale, are you gonna buy it?
yes,
Yes. If you buy my food, is it gonna be in my inventory? No. In which inventory? It's gonna be your inventory now, right? That's what I want. I want to move it from my inventory into your inventory. So what I'm gonna do? I'm gonna speed up my sales. How? I'm gonna offer you sales. That's why we have those sales. And I'm gonna send you an email that this product that you like so much is now on sale. Come and buy more. Do you pay attention when you're buying groceries?
yes,
Yes.
Which products are usually on sale?
Or maybe which are going to be expired.
Exactly. So what they're trying to do?
sell quickly.
Shell it.
Sell it. Why? Because they've been sitting there for more than what they want. So now they have to get rid of it. Why? Because become unsellable later. So now once you know the numbers, once you know how to interpret those numbers, you're ready for your quiz next time. Next time, again, you're going to have 4 questions. And one will be for chapter 1, one from chapter for the assets. You have to show me that you know how to calculate the cost of the asset. And you have to show me how to calculate the depreciation method which the management choose. And then you can comment on if somebody asks you questions, which one is higher, which one is lower, you to comment on that one. Then the last one is there will be 2 questions I told you for this chapter for the ratios. One definitely will be for the activity ratios. I want you to know those ratios. That's why I spent extra time to explain those ratios here today. Let's see if this is gonna pay it out.